Ever wondered about the mysteries hidden in the world of finance? Ever scratched your head over acronyms like TDS? Or puzzled over the difference between a trial balance and a balance sheet? Let's unravel these complex financial terms and concepts one by one. First off, TDS. It stands for Tax Deducted at Source. This is a method of tax collection where the tax is deducted from income at the time of generation. Suppose you're a business owner. Every time you pay an employee, a contractor, or even a rent, a certain percentage of the payment is deducted as TDS and paid to the government. It's like paying your tax dues in advance. Remember, TDS doesn't appear on the balance sheet. Instead, it's a part of the profit and loss account. Moving on, let's discuss the difference between a trial balance and a balance sheet. A trial balance is a bookkeeping worksheet where the balances of all ledgers are compiled into debit and credit columns. It's a tool to ensure the entries are mathematically correct. On the other hand, a balance sheet is a financial statement that shows a company's financial position at a specific point in time. It lists out a company's assets, liabilities, and shareholders' equity. So, a trial balance is a tool, while a balance sheet is a report. Next, let's tackle an intriguing question. Can a company show positive cash flows and still be in grave trouble? Well, the answer is yes. Positive cash flows only indicate that the company's incoming cash is more than the outgoing cash, but it doesn't necessarily mean the company is profitable. A company could be selling off assets or taking on debt, which would increase cash flows but isn't a sustainable strategy in the long term. Now, what about inactive and dormant accounts? An inactive account is one where there are no transactions for a considerable period. A dormant account, however, is a step further. It's an account where there have been no transactions for an extended period, often 2 years or more, and the bank has made multiple unsuccessful attempts to contact the account holder. So, while all dormant accounts are inactive, not all inactive accounts are dormant. Lastly, let's touch upon some common mistakes in accounting. These include not reconciling books with bank statements, not keeping receipts for small expenses, not recording cash expenses, and not setting aside money for taxes. Being aware of these mistakes can help you avoid them and keep your business's financial health in check. In summary, we've covered TDS and where it fits in financial statements, the difference between a trial balance and a balance sheet, the possibility of a company showing positive cash flows but still being in trouble, the difference between inactive and dormant accounts, and common mistakes in accounting. Understanding these concepts can help you navigate the complex sea of finance with a little more ease. So, keep learning, keep growing, and remember, knowledge is power.